Let's talk markets and let's see what happens with this jobs data. Again, very important day. If we see a big slide in jobs, it's not going to be pretty. Stocks down, gold probably up in that scenario. If we see jobs data come in better than expected, maybe the soft landing is still in the picture. Again, we will see. We're coming in here in just a few minutes, or sorry, a few seconds. Let's go ahead and do our breaking news coming in. All right, guys, you got S&P over here, NAS, Euro, gold. Oil is selling off a cliff. My goodness. You got pound up, dollar down, US 30, that's the Dow Jones, S&P, the NASDAQ flat. Look at this, dollar down. This would tell me that based off of the price action reaction, that jobs data not great. Oh, that's not what you want to see, guys. It's going to be a rough Friday. That's my guess. You've got average hourly earnings down. That's good for the inflation story, but that's no longer the problem. The problem is, look at this, guys. We got something to talk about today. Channel views about to go up. My account, not going to be pretty. 4.3% for unemployment rate. We ticked higher on the unemployment rate today, guys. 4.1 to 4.3%. That's going to get the attention of the Fed. And I wouldn't be surprised if September is now going to be heavily debated for 50 basis point rate cuts, and that leans more towards the scared side of things. They revised the previous number down for the number of jobs added in June. Yeah, so we're getting July's numbers here today, but they were revised June even lower. I'm sorry, no, they revised, yeah, that's right. Actual number came out much lower than expected, 176K. And if you remember, I was saying yesterday that what would have been a good number for me or for markets, my guess would have been a 200,000 jobs to 175 would have been a sweet spot, because then you've got jobs growth. But this is concerning. You've got low jobs data points here, and I wouldn't be surprised if that ends red today for stock market. You know, that's not pretty. Dollar down big time today. And again, why this is where you have to understand the interlacings of how this market works. A lot of people would say, well, dollar down, that should be good for stocks, right? It doesn't quite work like that, because it works like that when, you know, the economy is in a good place. But when the economy is looking worse now, because jobs data looks definitely not pretty, that's going to hurt the story for stocks too, right? If you're getting cooling in the economy, but the economy is really strong, then that's okay, because that's where you get down dollar, stock up. But right now you have a very unique scenario where we are now scared, concerned about jobs growth being weak in an environment where they're going to rate cut. Again, there's two different types of rate cuts. There's rate cuts that are trying to save the economy, and rate cuts because they can cut rates and relieve some pressure.
It seems like NFP, the way the numbers are quite low, I'm afraid that we might start to hear about recession, which is not really good because the market, actually the economy is slowing down. That is not really good for both whether stock market or the actual economy. And I think now Federal Reserve, they are forced to cut the rates. Let's hope that maybe they're gonna cut with a bigger number, or maybe they will just specify that maybe on the next session or on the next rate cuts, they're gonna add more, because at the moment it seems like things are worse. Higher rates don't really look good for this economy, so they have to do something. But at the moment, I was watching gold, which it was going up. It's like the market did not really react much to gold, and at the moment, I was also watching US 30, NASDAQ, and S&P 500. I think maybe once the market opens, we will see a nice reversal. I know that the market has been selling, especially on the tech stocks, but I think we will have a nice reversal, especially once the market opens.
Yeah, that's an interesting take on that also, because you mentioned if you're talking about a recession, concerns for a recession, I think, are definitely going to increase after today. I mean, Kenzo, this number, I was showing this chart earlier. This number is scary. I mean, if you take a look at the 114 number that just came out, it hasn't updated on the Edge Finder just yet. It will in just a few minutes. 114 is going to come in like right there, which is the lowest jobs data print that we have had in quite literally a couple years. That's a really, really low number. Not to mention, unemployment rate just went from 4.1% up to 4.3%. Now, these are still historically low numbers that the Fed is going to be working with. So I'm not necessarily terrified that, unemployment rate where it's at currently is at a terrible level. But what's concerning about this is that it jumping like this could be picking up momentum. Like next time around, it could be 4.4, then 4.5, then 4.7, 7, or that's the concern is now we have a very strong trend of labor data cooling down. I personally am still overall bullish on the stock market. I still like the AI trade a lot as well, but I have to be really careful because this does look like it spells maybe increased possibilities of a recession. And truthfully, for me, what that makes me a little bit more bullish on is going back to what I have been bullish on for most of this year, which is gold. Gold's breaking through the highs. I'm curious what your charts are showing you or what ideas you have specifically on gold. Are you more bullish today on gold? Are you not as bullish? Are you kind of bearish on gold? What are your thoughts on gold? Wait a second. What is that out in the water? Is that a shark?
Yeah, thankfully he only took half off my surfboard.
The markets can be a very scary place. Don't go wading into treacherous waters without your Edge Finder, which gives you market data like the commitment of traders data, retail sentiment, our top setups algorithm, which generates ideas each day for you, and so on and so forth. If you don't already have a copy of the Edge Finder, we're currently doing our summer sale, and it is our biggest discount of the entire year, no questions asked. If you're waiting for a better discount, you won't get it. Currently, the Edge Finder is half off. Check it out, and thank you guys for watching. Back to the show.
Yes, I'm actually bullish. So we were on a trade, but whatever that it's happening now with NFP. So I'm hoping maybe for a clear breakout, maybe we can continue adding more. Plus, that is not actually all about NFP because it's been going up. So even the tensions in on the Middle East, that is gonna worsen gold to push the upside. I think we still have a nice run because now I think it's quite clear that we're gonna cut the rates as the dollar is very weak, and the panic of recession might also add more on gold, and we might start to see some very new highs on gold.
Yeah, and again, you're seeing as we speak right now, just near the all-time high for gold, and what a crazy move. I mean, not to mention this is a day where the stock market is down 1.5%, and here's gold breaking through the highs. So a really interesting divergence there, and gold's been a really nice even hedge, not always, but in recent times been a very nice hedge to being long stocks. Gold again enjoying this for a different reason. People who are wondering why is, what's going on, people who are confused on this day, I want you to think about this. The dollar is down, but the dollar being down does not mean stocks have to go up. The dollar meaning going down on bad news for the economy is also right now bad news for the NASDAQ, bad news for the S&P 500, because it says, oh yeah, we might go into a recession, which is terrible for company earnings. But a recession or concerns about a recession are very good for gold because the dollar weakens, making the price per ounce of gold higher, right? The dollar is weaker, but also the expectations for stimulus and money printing go up, which is also bullish for gold. So gold is kind of the champion of the day, I would say.
Exactly. So for gold, I think it's still gonna go even higher as long as the dollar is not performing very well. That is gonna be the alternative of actually once we see US struggling like this, it gives gold a time to shine. And the worst thing is at the moment we have stock market which are also selling, but the number of whatever that we see on NFP, it's not really good because it shows the slowdown of the market, and that is also not good for stock market. So even though we might expect some recovery there on the stocks, I don't think maybe it's going to be just as quick as we thought, because a recession is not actually good for everything. Because now if you have products, people, they can't buy them because they are afraid to spend their last money because things are not looking very nice on the economy side. So which means we might see some slowdown. Yes, the market might try to recover, but I don't think we're going to see some crazy move at the moment.
Yeah, no, I agree with you. And I think that that's a good point. You know, the consumer has already been showing signs of cracking. I was going through this earlier, Kenzo, but this might be interesting just to discuss for a moment. This is XLY, which is a ETF that tracks a basket of stocks in the consumer discretionary components of the economy. So for listeners who don't know what that means, think about companies that, you know, people don't have to spend their money with, but choose to when things are going well. So like Nike, right? People buy Nike shoes when they have a little extra money. If you're thinking about Amazon, people do a lot more Amazon shopping when they've got extra money. Tesla, right? Obviously kind of a luxury car brand in the US. These companies make up big components to the consumer discretionary ETF XLY. Well, XLY has been getting crushed and today is down another 2.8%. And from its recent highs is down, you know, pretty big numbers here, 9%. And that's going off of, you know, something that's already been kind of struggling in recent times. So you take a look at the consumer, they're showing some weakness. You take a look at the tech trade, which is, you know, dependent on the economy staying strong, really. It's a bit of an ugly day for sure. What else are you watching, Kenzo? Did you talk about the dollar and with the dollar, do you think this has more room to go lower?
DXY, since we had a support, I think the market, it was struggling to break this support. I think since the market just broke out now, maybe the market might start to go even lower. So the question is, are we going here or maybe this area? So it's up to the market, but I think slowly we will see the market trying to go even lower. So that's not really good, but as long as if maybe the market will go slower, that is fine, because we don't really like a very strong dollar, but we just don't really want it to see it crashing. So it's like we need the balance actually. So that is quite difficult, but it's a good thing that we see the dollar losing the momentum, so that they can cut the rates. But if it just crash like that, that is not really good, by the way. But let's just wait and see. I think maybe we might see a smaller move going further, maybe a nice range going lower. That will be fine. But if we just see a straight move like that, that is going to be a panic, and that might cause a recession.
Yeah, that's interesting points there, especially that dollar index breaking the 104 level for the first time. Well, I guess it's breaking to a new low for the first time in many months. We saw this attempt to go lower on the dollar index and then strong bounce back. But the economy being so, you know, under scrutiny today is definitely making the dollar look a little bit concerning. I mean, if you get something like this, I would also not be surprised if sellers do step back in and continue to push this thing lower. I mean, we've really seen today, some signs that inflation is no longer a problem, but at the same time, we might have just swapped out the problem of inflation for a problem in the labor market. And arguably that is just as bad, because if you get concerns about a serious recession, it's like you mentioned, that concern could expand to consumers not being able to afford things, and that could cause businesses to lay off employees, and businesses laying off employees means the consumer gets weaker. That's like the cycle of a recession is businesses get weak, and people look to the Fed to inject some sort of liquidity back into the system to try and save the day. So we will see what the Fed does, but Kenzo, the probabilities for a 50 basis point rate cut in September have actually gone up. And I said this a week ago. Actually, whoa, look at this. It drastically changed. Look at this, Kenzo. So 30% chance that we see a 1 rate cut or 25 basis point cut. We jumped up to 70% chance of 50 basis point rate cuts in September. Wow. And on that same day, the stock market is down big time. So again, rate cuts are only good if it's accompanied with a strong economy. But rate cuts plus weakening economy or even, recession scared economy, not as fun.
Exactly. Yeah, and I think that actually that NFP, it's like way too low for quite some time. I think I never saw that for the whole year. So I think even Powell may be surprised because of the numbers. They will be obviously trying to press the buttons very quick. I think they will actually reach that 50 basis points. It's possible because they have to make sure that the rates are lower so that the economy can seriously bounce back as quick as possible. But we will see. I don't think 25 basis points will help at this moment.
Look at this, even Kenzo. To your point, I mean, 50 basis points seems increasingly likely after today's number, because now we're seeing by the December meeting, end of the year, the possibilities of many rate cuts are coming in. Now you're getting 4 rate cut possibilities. We're at 525 to 550. So that's 100 basis points. Very interesting. 125 basis points and 150 basis points being possible, at least by the odds shown in the Fed Watch tool. I mean, it makes sense though, because look at yields today. Yields are an absolute cliff jump. Look at this. This is the 2-year yield down to 3.947. We were just up in the 4.5s and yields just absolutely tanked. Really crazy to see that today.
Yeah, that shows that the rates are going to go lower. So 2-year yields rates are going lower. So that shows the weakness. So that's not really good.
No, it's very, very interesting to see that. And again, if you take a look at the Russell too, Russell is smaller companies, and smaller companies, yes, they want rate cuts, but they don't want rate cuts plus, recession. Recession for small caps is an ugly, ugly spot. Look at this. It blew right through the 61.8% retracement. We're sitting right at support for the Russell. But again, if you start taking out some of these levels, take a look at the NASDAQ sitting at support. S&P 500 not quite at support, but if these levels get taken out, again, we very well may see the carnage in the stock world continue. But very, very violent moves here today.
Yes, actually, especially on the tech stocks, I think we might still see some aggressive sell before we see some very nice moves, because mostly we know that actually for the stock market, it was supposed to be a good thing. But just because the stock market, it was already selling, I think we might see a continuation. Already we are on the support. Maybe we might reach 1720. Or 17,200 before maybe we see a very nice push. And if you still remember, we saw this push because of AI boom, and it seems like almost all those companies which were covering AI, they did not really gain much because they did release their earnings. We saw Intel missing the estimates, AMD going down. Almost all of them, they're not performing very well. Even though maybe there is Meta platforms, Apple is not really bad, but you can see that we don't really see any revenue from the AI, which they actually invested before or a few months ago. So that might make the panic to have a nice sell-off, because some of the sell-off is not really that bad. It's just that maybe they're just taking their profits as they see that there's no any growth. Then after, maybe once the market reaches this lowest levels, maybe the market might try to go back quite slower. Plus, we also have NFP, which is very weak. That might also help stock market to go up. But at the moment, I think we have so much stuff that we can try to digest. So it's no longer only AI, it's also recession, it's also interest rates, so many things at once. But there is a room for growth. Yes, we might have some sales, but I think a reversal might be there.
Yeah, it's the question is, where is the bottom on some of these moves? And it's hard to spot a bottom on this one because, you know, we just broke the 100-day moving average, we broke the 50, we broke the 20. The next line of the defense for the NASDAQ is like the 200-day moving average, which especially for stock traders on the S&P 500, the NASDAQ, the 200-day moving average is like the holy grail defense. If that breaks, suddenly you have probably a true bear market. Usually speaking, you know, market participants would take that as a generally speaking, a bear market. Starting is a break of the, well, usually a bear market, I think the is it a 20% or a 10% correction plus is a bear market. But, you know, we still have again, that's the thing. The S&P 500 has had such a massive run up. It very well may have a little bit more room to squeeze lower. And this would be a 12.5% pullback would get us back down to the April lows. I don't know if we get all the way down there or if this is more of a, you know, maybe we're going to see about a, 8% pullback, but it's kind of tough. Kenzo, if you were to be a buyer, what levels would you mark up as most interested to you on S&P 500, NASDAQ, any of the majors?
On a buyer, if I was a buyer, I was just going to wait for these two levels. The first one, it was where the market is, 18,470 or maybe 17,200. If the market breaks this level, I think the second level is going to be much better, and maybe at least the market, everyone will be thinking about buying around this area. It's where I can actually buy, or let's say between this area and that, it's where I can actually look for buy positions. So on S&P 500, I think it's going to be quite similar. On S&P, I'm waiting for this area also. I think it's quite similar to what you have drawn there. But the third one there, I think is quite not really that low. I think this area is what I am looking at. It's 5,300, I think, and 5.2. Those are the levels that I'm waiting for. But if maybe the market respect this, I will be ready to go in. But between this area, it's where I can think it's a very nice buy zone for now. But if the market goes below that, I think we'll be on a pure downtrend.
Yeah, no, that's a good point too. If it breaks some of those levels, that's where you start looking at where is this thing really going. I mean, if you start seeing 5,300, 5,200, if those levels start to break on the S&P 500, then I start getting a little bit nervous that we very well could see a move down to the April lows around 5,000. I think that, you know, as this S&P pulls back a little bit further, as you're getting closer to these levels, I would expect some reaction if this bull market is going to continue. You'd expect some pullback to this level to be bought to a degree. But if it doesn't, then yes, I'm totally with you. I think then you start getting worried about a bigger push down to like the 5,000 level, which some would say is a great, you know, longer term buying opportunity. And for the bears might actually be a big signal to kind of stay on the sell side of the indices for the time being.
Did you know we do a live trading show Monday through Friday with guests from all over the world? To get notified when we go live, click the bell button next to the subscribe button or check in at 9:30 a.m. Eastern Time. We have helpful, free content in the description below and on our website, a1trading.com. Thanks for watching today's video, and we'll see you tomorrow.